All right, so we're just going to jump into it. We're taping this in the third week of August. We're blessed again to have Andrew, who's been with us several times, to come on and go through, especially with a lot of timely topics. So we're just going to dive right into the material. Andrew, if you can kind of give us what your thoughts are. We're getting a ton of questions around the election. Obviously, there
Hmm.
was a big shakeup recently with who the players are, but
Yep.
in the grand scheme of things, are you really concerned, or is First Trust really concerned about the outcome of the election and what it's going to do, how it's going to affect markets? But
I mean, the first thing I would say is elections are always overhyped in terms of they do bring volatility. They certainly bring emotion. We are emotional people, and politics is one of those things that riles people up. There's ramifications, right? There's going to be some ramifications more related to next year, depending on the outcomes of the elections. We've got the sunsetting of the Trump era tax cuts. But here's the thing to remember: as you watch what's going on with the presidential race, you also have the House and the Senate, where on the Senate side, the Republicans have an advantage. They don't really have any seats up for grabs in this election that are in Democratic states, but the Democrats have a few, most notably Joe Manchin, who West Virginia is likely to go Republican. So if we see a Republican Senate, and let's say a Democratic House, they're going to be gridlocked in terms of what they can do. And once we get past elections, markets, people kind of get back to the general economy. So quite honestly, we watch the elections. We get a lot of questions as they relate to the elections, but I'm not putting in undue emphasis on the elections because the markets go up under Republicans, under Democrats. You have never been served well by pulling money out of the market, deciding to completely sit out depending on who is in charge. So, you can watch it if you enjoy it. If you don't enjoy it, though, feel free to turn the TV off and know that in the grand scheme of things, the impact it's going to have on your portfolio is short term, a bit volatile, but temporary.
yeah, yeah, we agree. We always say it's either 4 or 8 years somebody's going to be in there, and you just got to navigate through it,
Right,
for
right.
those 4 or 8 years. So
Yep.
changing topics a little bit. Obviously, there was a big correction in the market, and when you turn on the TV, you hear a lot of the talking heads talking about different things. They all know what happened. But one of the
Mhm.
topics that they brought up, which I think would be helpful at the highest level, not diving into the weeds, is this thing called the yen carry forward trade that they're
Yep.
blaming everything on. Kind of just high level, what that is, what it means to people.
It is. It is a complex topic. So the yen carry forward trade, to put it in the simplest terms I can think of, the idea was that interest rates were low in Japan and higher here in the United States. So people said, well, why don't I borrow the money in Japan? I'll borrow it at a low interest rate. I'll bring it over to the US, invest it even in something like treasuries at a noticeably higher rate, and then I'll just convert it back to yen to pay off my debt. And assuming that interest rates don't change, it can be a decent strategy. Not something I would try to do, but it's worked for some investors. When things shifted in terms of the Fed's expectations of late that they're going to be cutting rates sooner and Japan getting a bit more aggressive, there was a shock to the rates that people could get moving forward. And so some people who had invested heavily in this had to unwind. And here's the thing: anytime you have forced selling, anytime you have forced action because the dynamics have changed substantially, again, it brings volatility. I think it got a lot of TV coverage. But at the end of the day, I think, really, broadly speaking, what happened is that people have priced into perfection in certain areas of the market. And when there was this kind of, hey, not everything is exactly perfect, there's some unexpected things, the market took a little bit of a stumble back. Since then, it started to recover. Since then, it's kind of found its footing a little bit. You're going to hear about this, whether it's a Grexit, Brexit, BP oil spill, yen carry trade. The media always looks to try to explain what happened. They want to have the answer, but it was a lot of things that were taking place, and this was just the easiest one to blame it on.
I love that analogy. Speaking of that topic, on the broader topic of international investing and
Mhm.
non-U.S. investing, do you guys have any takes like U.S. versus non-U.S. right now, or
Yeah, so I mean, questions related to US versus international. First thing I would say is I'm more focused on the mid to the long term, not what's going to happen in the next week, 3 weeks, 3 months. I can't predict that. But when we look at the longer term drivers of markets, earnings are absolutely critical. And if you were to break this back and look over the last 10 years, 15, 20 years, one of the biggest things you'll notice is that the US has significantly outperformed. And the reasoning for that is that the US is the world center for things like technology. And as we, over the last 12 months, 18 months, there's been a heavy focus on things like AI. There's been a focus on cybersecurity. There's been a focus on new technologies. We are the critical leaders. I do think there's opportunities in international. I do think that it is trading at more attractive multiples than the US, but it's also expecting to see lower earnings growth here over the next 1, 3, and 5 years. I think that's the advantage the US has had as interest rates go down here in the United States as the Fed starts cutting. I think that's also going to be a bit of a catalyst. I like having some exposure to international. I think it brings some diversification benefits. But at the end of the day, the US is the most productive nation on the face of this earth. And we are the leaders. This is what free markets, this is what private property rights, rule of law do, that unlocking of innovation. And just to hit back on that conversation we had earlier on the politics, we spend so much time focused on things that are going on in places like Washington, but it's what's happening in garages, in basements, in startup hubs across this country that are really driving markets, driving economic growth forward. That's where, I'll be honest, that's where I spend the majority of my time, is looking at innovation, looking at activity, looking at what we, the people, are doing, because we are the ones that move us forward. And that's true both from an economic perspective and from a market perspective.
You brought it up a couple different times. There's a Fed meeting coming up, and there's been,
Mhm.
I think when we started out the year, there was going to be 100 rate cuts, and now. So can you talk your vision in regards to, as we're in August here, looking out for the remainder of the year, kind of what you guys are thinking?
Right. I mean, it has changed so substantially. If you go back to the beginning of this year, the market was pricing in 6 rate cuts with a 90+ probability that the first one was going to be happening sometime in that March, April, May time period. By the time we got to June, the market was saying, no, it's going to be 1 rate cut, because inflation, rather than really significantly moderating, had kind of leveled off and in fact turned a little bit higher. Well, in recent weeks, I do think some of the impact of higher rates is being felt. It operates with a lag. When the Fed raises rates, you don't see the impacts on the economy overnight. It can take 6, 12, 18 months. We've seen some moderation in employment. We are seeing some moderation in the inflation data. Now, since June, since even the beginning of July, the market's now expecting, and I agree, that we will see a rate cut in September, barring some major action, major geopolitical event happening between now and then. And the expectation is they're going to cut in September. They may look to do one in November, which would be right after the elections. And the market's pricing in right now a 50 basis point cut in December. So by the end of this year, interest rates being 100 basis points or 1 full percent lower than they are today. The Fed is certainly leaning in that direction. They would like to cut. The thing I am watching for is, how does the economy react to that? Because one of the biggest risks the Fed has had throughout history is starting the rate cut process, getting a bit too aggressive, and seeing inflation pick back up. That's going to be a critical risk, a critical consideration in 2025. But for the next meeting that we have next month in September, I expect the Fed is going to start the process of bringing rates down.
Yeah, we agree with that too. Now, you guys at First Trust did a lot of work on this concept called the market starting to broadening out. It's been relatively
Mhm.
narrow. Can you
Mhm.
touch on what that means? Because I don't think a lot of clients know that there was only like 7 to 10 names that were really driving everything. But kind of, and I know you guys did a lot of work on this, so if you can expand on that concept.
Yeah, absolutely. So if you look, for example, at last year was one of the most concentrated market movements that we've seen in decades. And what that means is the S&P 500, contrary to its name, it actually has just over 500 companies. But of those 505-ish companies, only about 20 to 25% of them were outperforming the market. It was a small subset. And we think about the Magnificent Seven, the names that got a lot of media attention last year, they were major drivers of market activity. Well, you think there was the Greek story, and I can't remember if it was Atlas or Sisyphus, where they were pushing the rock up the hill, and they'd push it up the hill, and then it would roll back down. If you have, 7 stocks that are pushing this rock up the hill, and one of them fails, one of them has difficulty, it's harder to keep the momentum moving, pushing the rock in a direction. But if you broaden that out, if you have 100 people, 200 people, even if they aren't quite as strong, even if they aren't quite as large or powerful, when you see that broader activity, one, it tells you, look, things generally speaking are going well for companies. But that broadening out, it also provides more stability. And in a year like last year, because here's the thing, in 2023, the Fed kept interest rates high. Earnings actually fell a little bit in 2023, and yet the markets rose by more than 20%. It came from a lot of PE expansion, people paying more for every dollar of earnings rather than the earnings growth. And when you see that, that's kind of a sign of, okay, let's be maybe a little bit more cautious. But when we see the broadening out, when we see that the average company, let's say, is seeing better performance, they are more reflective, they're moving along with the market, that's a sign that we're less concentrated, that I think we're a little bit less at risk of dramatic pullbacks from one or two names not doing well. It's what you really want to see over time. And the market goes in swings where it narrows, then it broadens out, it narrows, then it broadens out. Over the last few years, we've certainly been more narrow. I think that that's going to also be a key theme here over the next few years, of this broadening out, more participation generally among stocks. And that's a very, very healthy thing to see.
Yeah, we agree. That's a really good thing. As we wrap up here, because we like to keep these kind of short, I know we're a big planning firm, so we believe as long as you got a good plan, we'll weather the storm, go through there. For you guys at First Trust, what excites you, and what are you kind of optimistic about as we come at the last last quarter of the year here, and we kind of start to end the year out?
Yeah.
And looking into 2025, what's out there? It's like, yes, this is like awesome, or we're excited about this.
Yeah, I mean, there's a lot of things. We look at things on both sides. Now, I'll say I'm generally an optimist. I look at the world around me, and I constantly spend time looking back at where we came from, looking back 10 years ago, 20. I love to look back at old ads and see how much the technology has shifted. I just came back last week. I was in Philadelphia, which is where my whole extended family is at, and I was with my 93-year-old grandmother, and we were talking about what the world looked like when she was growing up. I was talking with my aunts who were in their 60s and talking about what the world looked like. And I'm sitting there with my 6-year-old and my 9-year-old by me, and I'm just realizing how much information is now out there for the next generation. The tools they have are unlike anything that we've ever seen before. And the advances that we are making on this technological front, whether it's with semiconductors, whether it's with tools to improve, I like things like photography and AI, it's still making its way through a lot of areas of the economy, trying to figure out how we're going to use it. But there are specific areas in healthcare, in some of the entertainment space, where we're seeing those early glimpses of what the new processing power can do. And as my kids are about to go back to school, schools are starting up, I think about the information, the tools that we're arming the next generation with, what this generation is building off of from the generation that came before. And I will tell you, I think that technology is accelerating at a pace that we really haven't seen. And we are unlocking human potential today at a way that we have never seen in the history of this earth. It's been a process that's accelerating. And I think Mark Andreessen was the one who said it. He said, technology has never moved as faster as it does today, and it will never move slower into the future. This is one of those trends that's improving global outcomes on health. It's improving global outcomes in terms of poverty reduction. Right now, this is a side note, but this got me really excited as I go in towards the end of the year, right? I was doing data on poverty reduction in the United States, across the globe. And over the last 20 years, this number shocked me. We have been averaging pulling about 120,000 people per day out of poverty here on this earth. And if we continue that trend here over another 10 to 15 years, we could basically have extreme poverty eliminated here over the next 15, 20 years. I'm in Wheaton, Illinois, where we have about 60,000 people. There are 2 times as many people per day leaving poverty than there are in this entire mid-sized town that I live in. And to me, when you stop and appreciate that, it's incredible. and you consider the education that they're starting to get in developing markets, the access that they get to technologies as we develop them and then we broaden them out, I think what we're going to see moving forward, and this is why we invest over time, because we don't know what's coming, but the momentum, the incentives that are behind us, I think are going to make the next 10, 15, 20 years an incredible thing to witness.
Yes, I love ending on a positive note. And one of the things, just as we wrap up here, that we want to share with our clients is these are the people that we have access to. These are the people that help and make decisions. These are the people that help become stewards of your money. So we want to bring them, take them out of the shadows and bring them to the forefront so that you guys get to act or see them in the light that we see them. Again, I want to thank you so much for doing this, Andrew. We appreciate it again. We'll probably get on the phone, 4 or 5 months from now and do it again. So
Thanks, Joe. Thanks for having me. Take care.